Every week, two stocks hit new highs for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. Right now, the message from 52-week highs is clear. Market strength is broadening. We have a record number of companies on our list. Leadership is shifting towards financials, industrials, and materials. That raises some important questions. Could the AI bubble be spreading beyond big tech? And is financial pressure finally eating the rich? Today, we'll look at GE Vernova and American Express to answer those questions. That way, we understand what's really driving the market. First up, GE Vernova. The company spun off from General Electric a couple of years ago and is now a lean, focused player in power generation, grid electrification, and renewable energy. Right now, the world is demanding more electricity than ever, not just from homes and industry, but from massive AI data centers that need reliable, high-volume power. GE Vernova is right in the middle of that boom. Its power segment, especially gas turbines, is the backbone, supplying electricity where it's fastest and most reliable. Its electrification segment, transformers, switchgear, and grid software, is also surging. Utilities and hyperscale data centers are snapping up GE Vernova's equipment as they upgrade and expand their grids. Orders are up 55% year over year, and the backlog is growing so fast, the company couldn't keep up if it tried. Gas turbine slot reservations are sold out through 2028. Bottom line, this stock is hitting new highs because demand for electricity and the gear to deliver it is through the roof. Looking at the numbers, GE Vernova's demand is screaming strength. You can hear it in management's voice. The order book and backlog are strong and deep, driven by both power and electrification. This isn't a short-term spike. It's broad, real demand. Investors have excellent revenue visibility. The only bottleneck is how fast customers can actually build the facilities to execute on GE Vernova's orders. The power segment, especially gas turbines, is the backbone. Organic growth is strong and margins are expanding, showing clear pricing power from tight supply. Margin expansion is what's driving net income growth. Margins have basically tripled, which means every additional dollar of revenue now flows through to profit even faster. And that's why investors are so excited. GE Vernova plans to reinvest about a third of free cash flow into acquisitions and organic growth. This strong position allowed them to acquire Prolec GE, another GE spinoff that makes transformers. Folding it back into GE Vernova gives them a more vertically integrated business. History has a way of repeating itself, and sometimes very quickly. Analysts are predicting insane growth, 41% annual earnings growth for GE Vernova over the next 5 years. That's why the stock trades at a forward PE of 60. But let's be real, that growth can't last forever. If GE Vernova eventually returns to a more reasonable 20 PE, even with all that growth, it would only match the market. That's an extreme hurdle to climb for a market return. A small dip to 35% growth a year, you're looking at a 46% return over 5 years, underperforming the market. My take, the business is solid, but the stock already prices in almost all of the growth. I'd wait for a massive pullback before getting in. GE Vernova's biggest risk is multiple contraction. If that PE drops to 20, returns get nuked. Execution risk is real too. Scaling production to meet this massive backlog is a huge operational challenge. And it's not all in GE Vernova's control either. Permitting delays or other customer-side issues could slow revenue, even if they are ready to deliver. The takeaway? A hot business doesn't always mean a hot stock, especially if the upside is already priced in. Always check if growth is baked into the valuation before jumping in. Next up, let's switch gears from energy to finance and look at American Express. Could their premium customers' growing reliance on credit cards be a warning sign of economic weakness? American Express isn't your everyday credit card company. They run what they call a two-sided platform. On one side, they attract high-quality, spending customers. On the other, They connect those customers with merchants who want their business. Both sides have to agree to play, and that creates a premium, sticky ecosystem. Amex isn't chasing growth by lending recklessly like some banks. They're focused on spending. The more cardholders spend, the more merchants pay to be a part of the network, and the more Amex can reinvest in perks, benefits, and experiences to keep that loop going. Right now, growth is coming from several fronts. They're bringing in younger customers, millennials and Gen Z, who are signing up in huge numbers and spending way more. International markets are expanding, giving them a big runway outside of the US. Their premium customer base is thriving. These folks are spending, not saving. It's not just the wealthy. Amex watches their competitors closely. They see a higher credit quality across all income brackets, a trend we've seen on the channel too. This goes against the media's doom and gloom narrative. Let's talk numbers. American Express is seeing strong growth across the board. Consumer spending on Amex cards is up about 9% year over year in the US. International growth is extremely strong as well. Their customer base isn't just stable, it's accelerating. Millennials and Gen Z are big drivers here. These younger customers aren't just signing up in huge numbers, they're spending more than older users and doing more transactions. Credit quality is solid too. Defaults are stable, write-offs are under control, and most new growth comes from premium, high credit customers. This has translated into impressive results for shareholders. Dividends are up more than 50% over the last 3 years, and the company is buying back a ton of shares. Best of all, there's still plenty of capacity to return even more capital, since they're only distributing about $8 billion of the massive free cash flow they generate. This combination is what has investors excited. Amex customers are spending more, reliably paying their bills, and that has pushed the stock higher. The media may talk about economic stress, but it isn't showing up in Amex's numbers. Their customers are doing just fine. Basically, the financial picture is healthy, growing, and high quality. Exactly what you want from a premium card company. Now let's talk valuation. American Express growth has accelerated, and the market has noticed. The stock trades at a premium, around 23 forward PE, reflecting this. That premium makes sense if Amex keeps executing and growth stays on track. The forward PE translates to about a 4% yield. Add in expected earnings growth of roughly 10%, and you're looking at around a 14% total return. Plug that into our valuation model, holding the forward PE steady, and you get a 93% return over 5 years. Slightly ahead of the market. My take, this is an anchor stock kind of play. You're not buying it to crush the market, but it's a high quality name you can build a portfolio around. American Express's business is solid. Payment networks like theirs have a strong moat. That said, the biggest long-term threat is crypto and alternative payment systems. If the way we transact shifts significantly, Amex's ability to charge those high merchant fees could be disrupted. It's not an immediate concern, but it's something to keep an eye on as the payments landscape evolves. The lesson here? Premium consumers are doing well, which is fueling Amex's returns. This is a stock to watch, a high-quality name you can add to a portfolio of solid, reliable companies. So wrapping up, GE Vernova is a powerhouse in energy, riding the AI and data center boom. But the stock already prices in a lot of that growth. It's exciting, but patience is key. American Express, on the other hand, is a premium, high-quality play. Growth is strong, consumers are spending, and the business model is defensible. It won't skyrocket like a hot tech stock, but it's a solid anchor for any portfolio. The lesson here? Know the difference between a great business and a stock that's already priced for perfection. But the broader takeaway? Mispricing might be hiding in the AI-related names few people are watching, not just the big tech giants. Also, the premium consumer isn't just holding steady, they're accelerating. That could be an early sign of a broader economic recovery. That's it for today, guys. If you found this helpful, hit like And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. Thanks. Bye.